Okay, so in this video, we're going to talk about what stocks to invest in during a recession. Okay, so the first question I want to ask when it comes to recession is this idea of interest rates and tech stocks. Like, what is the relationship? Like, how do interest rates affect growth stocks? So I want to talk about that first. So it is very common to borrow margin, to use borrowed dollars to invest in something that goes up in value. So imagine borrowing money at 3.5% so that you can invest in something that goes up historically about 20%, right? And you can kind of pocket the difference, right? And that is very, very common. Well, the catch, this is what most people have done up until the end of 2022. The catch is this really only works when two things are correct. It really only works when two things are accurate. And the first is when interest rates stay low, meaning that borrowed money, 3.5%, as long as it stays low, it doesn't get to any ridiculous 8, 10%, right? And the second thing is growth companies continue to increase in share price. So if either one of these do not remain correct, or let's say interest rates go up or growth companies go down, this is kind of where we are right now. So if I was to flip over here and you were to look stock chart, this is a chart of the QQQs. And obviously through all of this chop, this up and down, as long as we're continuing to make these pivots and make new highs, as long as we're bullish and continuing higher, that strategy of using borrowed dollars to continue to invest in things that go up in value remains true. However, something really dramatic happened right here, right? And it's like it broke the trend and then it's continuing lower. So I'm not saying that this right here was the moment of the recession, but this was, anyone who can look at this chart can notice that something happened, right? Something different has occurred. And so as long as we are going in this downward trend and we're continuing interest rates, war in Ukraine, like all kinds of things are happening, I want you guys to think of trading stocks. I want you to think of stocks in really one of two buckets. And this is where we are right now. And this is on the left here is growth companies, and on the right is cash generation companies. So a growth company would be something like Amazon, something like Roku, something like Shopify, Mongo database, NVIDIA. Like these are companies that tend to grow quickly. Usually tech stocks grow quickly. Usually all the growth companies are tech stocks. Now, they may or may not necessarily be profitable, meaning generating cash, which is why they aren't on this side over here. They are over here. And their valuation is based on the PS ratio. PS ratio is something you can find for each company on FinViz, and it just represents the price to sales ratio, meaning the stock price, how much the company is growing. It's a multiple. And then this is kind of based on the venture capital money model of growing companies very, very aggressively with the future hope of making a profit at some point in the near future. And most of these companies use a land and expand strategy, meaning get super aggressive with sales and marketing and try to get as many customers in the door to kind of starve them and take them away from your competitors. It's a very common strategy, land and expand. Now, these companies that are losing money obviously are not going to be paying out dividends. Because why? Because dividends are cash that's rebated back to shareholders. And if you're not generating cash, you're not making cash, you're not generating cash, you're not going to be rebating it back to your shareholders. And then here's some more examples: Shopify, Alibaba, Square, NVIDIA. Again, these are all growth companies. And this is what we've been investing in for years and years and years up until the turn of the year, up until the beginning of this year. And the opposite, the polar opposite of that would be cash generation companies. And what I'm saying is we are moving away from this model right now, presently, if we go into recession, into this. Now, why are these companies always profitable? Well, these are slower companies. These are mature companies. These aren't companies that have been around 6, 7 years. These are companies that have been around 10, 20 decades, 10, 20, 30, 40 years. And their valuations are based on price to earnings, the PE ratio. This is a private equity type model, meaning they buy companies that are generating cash because they're generating cash. This is a Warren Buffett type company. These usually, not always, but highly likely to pay a dividend. Here's some examples of Apple, American Express, right? Coke, Bank of America, US Bank. And those are the types of companies where people are transitioning from the growth companies into the cash generation company. And I want you to think about, in a recession, the companies that are losing huge amounts of cash, one of two things are going to happen. They're going to have to raise more money by either selling bonds, like selling debt, or they're going to have to do like a secondary offering where they're offering more shares and selling it back up on the market. Either way, you're kind of not in the ideal position if you're in that spot. If you're like Snapchat, if you're losing massive amounts of cash and your stock is low and your coffers where all your bills are paid out of are continuing to go downhill, the balance is continuing to decline. So if you wanted to see a little bit about, this is kind of where we are, we're kind of getting away from growth companies, getting more into those cash generation companies. Here's a couple of examples, and you'll notice this is a screenshot straight from FinViz, and that these companies on this list here, growth companies, do not offer dividends, but they do grow quickly. Most of these companies here grow quickly. Some of these had a bad quarter due to supply chain issues with parts and that kind of thing. So these are growth examples of growth companies. Now, a cash generation company, companies that are generating cash, would be something like this: Apple, American Express, Bank of America, Chevron, Heinz, Kraft Heinz, Coca-Cola, Moody's, US Bank, Bancorp, and Verizon. Like, these are companies that if they are paying a dividend, they have to be profitable. 99 times out of 100, these are profitable companies. Why? Because in order to rebate a dividend, in order to pay cash back to your shareholders. So here is a side-by-side comparison of this. On the left, you'll see this is Tobias Lutke. He's the CEO of Shopify. On the right is Warren Buffett. So the focus is shifting from growth companies now to cash generation companies, shifting from these companies where you could borrow money cheap and they were high flyers and you can make tons and tons of money very, very easily. And the focus is going from growth companies to these cash generation companies. Why? In a recession, cash is going to become scarce. So if you were to look at kind of where we are in this timeline with the Fed and the whole, like, this is another thing that impacts all of this, is in June, which we are currently in June, the Fed is going to start unrolling / selling 47.5, that is $47.5 billion off its portfolio. Now, that's a lot of money, but they're doing that starting in July, of course, per month. So they're starting it now in June, in the current month, and they're going to be doing that every month going forward. And we're going to stay on course. And then by September, it's going to continue increasing that. So here's what happens. And this is what happened the last time. So as the Fed is using money, pretty much essentially printing money to buy up these assets, which this lull right here was COVID, and using that to artificially increase the demand. What they're saying is, now that we've done this, we're going to start undoing this. And it's been trending up ever since, right? Since they started doing that. Well, now what they're saying is we're not going to be doing that anymore. We're not doing that anymore. Not only are we not doing that, we're going to start reversing. Well, if they things continued higher when they did that, what do you think is going to happen when this starts kind of selling off, and they start getting back down here to, this is like the 2008 era, 2008, 2009. Now, last time they did this, they had about 20% of their, they did about 20% of what they were initially intending to. But we're not at 2 billion trying to offload we're not trying to offload 2 trillion. We're at a much, 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 much higher number now of, much higher number, almost $9 trillion we're trying to offload. Okay. And so as the Fed is selling some of that stuff back on the open market, who are the buyers? So there's some turbulence ahead. Absolutely going to have some turbulence ahead. So what I want you to do is I want you to think about, what are the types of companies that you can invest in? So here are some companies. These are listed as the top positions from Warren Buffett. And this is kind of what I'm thinking. This is what I'm thinking. These companies that Warren Buffett owns are all cash generation companies. They're all generating cash, right? And if we're looking, we're stop looking at growth companies, we're now looking at cash generation companies. Do you think owning a piece of these companies that pay dividends, whether or not the stock goes up or not is a different story, but these companies that are paying dividends, and he has pretty sizable positions on these. So what I'm saying is that these companies that are owned by Warren Buffett, this list here, are companies that are consumer staples, right? Kraft Heinz, Coca-Cola, credit cards, banks, computer, like all these cell phones, these gas and oil, like these are all things that are need to be that are consumed, or everyday kind of interactions with the everyday person. So things like luxury vacations, luxury items, and travel typically are slowed and paused during a recession. And that is indicated by Warren Buffett kind of offloading some of his travel, his airline stocks. And these are the types of companies, not necessarily these exact companies, but these are the types of companies I want you guys to be thinking about as you are building out your game plan for what you're going to invest in with the coming recession. Thanks, team. Let me know if you have any questions. My email is matt@reallifetrading.com. Look forward to hearing from you.